Welcome to the daily update. This is being prepared Thursday, August 11th, where we'll look at the action in the market today and then see how things look for Friday, August 12th. It was kind of a negative day. We weren't down all that much on a closing basis, 0.07%, but we gapped a lot higher at the open, set the high not too much longer after the open of the session, and then spent the rest of the day falling back. So it could look like another failed rally attempt. We were able to break above some resistance and even hit some resistance, but then we backed down from that. We're still looking positive, though, overall. Some of our scenarios and our positive setups, a few of them actually improved with the longer term measurements. Our sector rotation took a bit of a hit, but it's still positive also. So we just have to see where we go from here, because value really outperformed growth in Thursday's session, even in the light of some weaker than expected economic information. So let's go back and look at this. Right at the open, we did have a gap higher. We went above R1 at 42.22. We even went above R2 at 42.33. We never made it up to R3 or R4. We just didn't go that high. The spread from Wednesday's session was just too much. We set the daily high at about 42.58. Remember, I round up or I round down with these numbers. I don't use the decimal places. I just want to give you an idea. Plus, a lot of you don't really care about the decimal places if you're doing options. You want to know about strike prices. As the day went on, we set that high and then we retreated. We went back down below R2, then down below R1. We went down to the unchanged level, broke below that, and we actually fell to the daily pivot, which was below the unchanged level. Going into the close, we ended up closing at the low for the day, but we were only down 0.07%. So on a close by close basis, it doesn't look that bad. But when you look at the intraday chart, it's kind of disheartening with how things played out. Hasn't changed anything so much, but this is looking like a failure right now. And we have to see, are we going to carry over with this? Is this going to go into Friday's session and maybe into next week? Or was this more of a one-day anomaly that we're seeing? Volume still was below average, and the technicals, they're still positive overall. Unfortunately, with these small downs that we've been having, the less than 0.5% declines day after day, it really, meaning when we're having down days, it really hasn't worked off that short-term overbought situation. So it'd be nice if we had a little bit more of a closing down figure that would help some of the indicators. But because it's so small, they're just lingering about in extreme positive territory. Now, at the same time, we can stay that way for a while, specifically overbought. A market can stay overbought for many days, if not a few weeks. And so that's not a real big concern, but it's just something we want to be aware of. The markets are still really fixated on inflation and interest rates, and then growth concerns within companies, within the US economy at their individual level. We have the whole list of geopolitical concerns, and none of them are really affecting the markets all that much, but that could always change. Earnings are coming out, some are positive, some are negative, and then we're still kind of going back and forth with what is the definition of a recession? Are we in one? Are we not in one? Whose definition are you going to believe? My personal take on that is we don't really care. We're just following what the charts say and then act accordingly based on that, instead of getting in these useless debates about how you define something. Let's just look at things for what they're really telling us and then make our decisions that way. That's usually how I come out on things. You may not necessarily agree with that. And in different contexts, there might be room to disagree and be justified in that scenario. But when it comes to the stock market, we just have to look at what's going on based on the other evidence that we have. So what are some comments that we can make? The PPI was lower than expected, and it actually declined, similar to what happened with the CPI on Wednesday. Growth during the session really lagged. Even when we were up strong at the open, I saw where value was really outpacing growth, and I thought, this is not going to have any legs today. And that's really what ended up happening. Value was in the lead. Once we set the high and we started pulling back, it just kept going down and down and down. So if you do watch intraday charts, that's a good thing to keep an eye on. And I have a screenshot of what I look at that I'll show you here in just a moment. But watch how value and growth are interacting with each other. If value's in the lead and we're up, be suspicious. If growth is doing really well and we might be slightly down, that could give some support to the market. Small caps and mid caps actually did better than large caps in Thursday's session. Our sector rotation, our positive setups, they weakened a little bit, but they're still positive overall. And I have to cough. Sorry about that. The 10 to the 2, the 10 to the 5, both of those yield curves remain inverted. Nothing's really changed in that regard. Fear is neutral. We're at the 52, 53 range right now. And some of our short-term overbought indicators, some of them are working off where others really aren't working that extreme positive reading off right now. We had the PPI that came out and it was down 0.5%. They expected it to be up 1/3% or 0.3%. Sorry. And that was quite a bit weaker than expected. The core PPI, which takes out food and energy, it rose 0.2%. They expected it to be up 0.4%. So the headline numbers and even looking a little deeper show that we saw a weaker than expected report. And that's feeding into this scenario. The CPI did it on Wednesday. The PPI did it on Thursday, that maybe inflation is topping, going to start to come down. Maybe the Fed at some point will be able to get a little less hawkish by slowing down raising interest rates. And then at some point turn more dovish where they're focused more on the economy. And if things really start to show more weakness, possibly even cut interest rates. But that's far off into the future right now. Jobless claims were at 262,000. That's 1,000 less than what they expected. And our trend, it's still positive. And I'm keeping the biases positive now because when we've had up days, they've been pretty significant. When we've had down days, they haven't been all that significant on a close over close basis. And I'm keeping our momentum positive too. We're looking okay technically. We want to see some more follow through based on price, and we want to see growth really pick up the slack and start to move higher. All right, let's go back and talk about today's session. We are at 53 right now with our fear and greed index. Here's the historical chart. And for some reason, the charts are hanging. So I apologize as I advance going forward here. We did get the AAII reading, and it showed a little bit of an improvement, even though they're still below zero. You have individual investors. They're still negative overall, but they're showing some improvement. Here are some Isabel net charts, and this is the valuations comparing that to the percent deviation from exponential growth and the trend that we're seeing. Really, all you want to do when you're looking at this chart is this green area. If it's going down, then you're probably seeing the cap valuations, and that this is based on the Robert Shiller way of calculating the PE ratio, then this is probably going down as well. If these green lines are going up, then we're seeing the cap valuation also start to go up. Well, look over on the right-hand side. We're seeing a disconnect right now where the green has been going up and the CAPE valuations have been coming down. What's going to have to happen here? These two generally need to get back in line with each other. And so our valuation is going to need to come down, or is the CAPE valuation going to need to go high? Now, it's historically high also. And I show the CAPE chart in the weekly update video that I do. And it still shows that on a look back basis, historically, the market is still quite overvalued. Looking forward, it's not necessarily overvalued, but we want to get some historical context here as well. All right, then here we have kind of a scary looking chart. This is just suggests that sometimes when we have a midterm year, which is what we're in right now, it can start off very weak, but then the second half of the year might be very much improved. And this just compares after day 150, which is considered the halfway point, and all the different years over on the left-hand side. And most of these ended up being midterm years. And then after we got past the first half of the year, how did things perform going forward? And the average is that we advanced 7.9%. The median is 2.9%. We did have one crazy situation in 1974. And if you remember what was going on then, we had a president have to resign during that time. So things were not looking very good. We ended up having a president assume the office that really had never been elected. He was more appointed and then made his way into the presidency. The nation was really having some trouble about that time. Not the only cool thing that happened that year was Evel Knievel tried to jump the Snake River Canyon and didn't make it, but still lived to talk about it. So we have a 71.3% positive rate on all of the years. So there is some historical precedence to suggest that when we had a really crummy first half, the second half might look better. There's no guarantee, but this is what has happened before. And we're kind of seeing that unfold when we look at some of the evidence right now. Now, this could change as we keep going on and on and on. We're seeing positive things now, but that doesn't necessarily guarantee that a few weeks from now or a month or even 3, 5, 6 months from now, things are going to remain positive. There's just too many variables for us to consider to be real dogmatic about things staying as positive as they have been looking lately. All right, then here we have the old CPI. The red line are the sticky prices. These are the ones that don't change very much. And this red line has been going up. The flexible prices, the ones that can change after really spiking up, they have been coming down. But I guess if you want to buy some flexible price things, and the Fed has these categories for what is flexible, what is sticky, and it can get kind of convoluted and it can change. And you're like, wait a minute, the food that they're using to compare prices with, I don't even eat any of that food. So how is that useful to me individually? So just take this for what it's worth. Right now, we're seeing a real jump up in buybacks. Now, a few days ago, I showed a chart where buybacks were actually declining. This chart is suggesting, put out by Goldman Sachs, that we're seeing a lot of buyback authorization announcements that a company says, yeah, we just might buy some of our own stock back. With prices falling, they get it at a cheaper price. That's one advantage for them. Another thing is, would these companies be buying back their own stock if they didn't have a lot of confidence in it or even announcing that they're going to do that? So this I see as more positive. Prices are lower. The companies are saying, yeah, hey, look, we can get our stock at a lot cheaper now. When we buy back that stock, that makes less stock available out in the market, which can also push up prices because now each share of stock is a little more precious. And so that can help the overall market. All right, then here, this is crazy. And you probably heard of the Green New Deal and the whole shift of trying to wipe out oil and fossil fuels and things. Well, how's that coming along these days? This chart says hydrocarbons still dominate the global energy mix. And that may be what's happening in the US, but what is India doing? What is China doing? They're not into this green new anything. And so even if we shift over into that kind of an economy to try to lower the carbon footprint, is that even going to make a difference? Because other countries are saying, we're not going to do that. So that's part of the thing going back and forth right now. But at the very top, it just shows this dark green. That's how much we get from wind right now. And then this other like green area here is solar. That's even less. And then nuclear is the yellow area. How come they didn't have that a fluorescent green? I don't know. And then hydropower, these are dams and different ways of using water. And if you're from the West Coast like I am, you got a lot of dams all over the place. And then oil takes up the big part. Gas is the light blue, and then coal is the red. So even with the shifts that we're starting to see, it's still a very small portion of the overall energy that's being generated by these newer technologies that we're seeing. And that just means that we have a long ways to go if this is going to happen. And I understand they want to get all of this in place by 2030. That's 8 years from now. Can you shift everything over in that amount of time? And that's part of the debate going back and forth. All right, here's another chart showing the VIX and the 3-month VIX relative to the VIX itself. And we're seeing a bit of a positive divergence here. On top is the S&P 500 with some lines on here, and we're right at some resistance now, similar to what I've been showing, where when we're looking at the 3-month VIX relative to the daily VIX, we are seeing this bullish divergence. It's not coming down as much. Now, can that be positive or is that negative? Because usually when the VIX rises, that just means that there's more fear. When the VIX really starts to go down, that means that people are getting more complacent. And so what they often do with this is that they will invert the scale. And it doesn't look like that's really what they're doing here. It's just showing a chopper recovery has confirmed the rally. So the VIX has been chopping and showing a bit of a bullish divergence based on this chart. All right, now this is just fairy tale land as far as I'm concerned. The CPI and the PCE, that they'll be about 5% in the first quarter of 2023. And this is assuming. And of course, you know what happens when you assume. You make an ass out of you and me. But look at these headline numbers here. We're not even getting anything close to that with our readings. So what usefulness is this chart to me? And these could change at any time. But the thing that I would take away from this is that we are seeing a decline in inflation with the projections that Bank of America is starting to put out right now. All right, we had an update of the GDP Now forecast, which is suggesting that we will have a positive GDP in the third quarter. Yeah, that's going to be the debate going back and forth. And if it's positive, you'll have the politicians patting themselves on the back. If it's negative, they'll change the definition. So we kind of have to just take that for what it's worth. And this is looking at the different sectors. The one takeaway from this is that we're seeing a lot of inflows into tech. And this is a relatively recent chart where this lighter blue line just shows a lot of money, and that's growth. Tech is growth. Where we're taking the money out of is healthcare. Discretionary has been getting hammered, but it's been recuperating a little bit as well. But we're starting in communication. That's the weakest sector so far this year. So this could help support this idea that we're rotating from value back into growth. All right, well, this is the sector chart that I look at, the closing basis. You can see we were up 0.43% with value, down 0.43% with growth. And we were lopsided that way. Even when we were positive, value was really outperforming growth. But the mid caps, they were up, but still underperforming. And the small caps were up and also underperforming. But the mid caps and small caps did a little bit better on their indexes. The VIX went slightly back above 20 now. So there's just a little bit of fear coming in. We're seeing a bit of an increase in the volatility of the VIX. The Ulcer Index daily chart not helping us. The weekly chart is still showing a slight decrease in fear. We're down 12.69% from the all-time high set back in January. The one-day chart of the equity put-call ratio shows a decline. The 5-period shows a little bit of a decline also. Looking at some support and resistance, here are the pivot levels for Friday's session. And again, you might want to pause this. I hope you can see these numbers listed up here. These to me are very, very important, and I use them on a 10-minute intraday chart. Here's the daily chart where we came almost up to R1 and then fell back down, and we're still above this short-term resistance. So we've still been able to break above that. Can we stay above that now? Because this was a big deal to break through. We need to see some follow through to get above R1, to get above this longer term resistance and possibly start to deal with the 200-day moving average. On the bottom, you can see where volume was below average. Here is the daily chart with the updated candlesticks, but these are the pivot points for the entire week. Here's some retracement where we came almost up to this 50% retracement level, and that acted as overhead resistance and then came back down as the day went on. Here's our other fib chart showing the same thing. We came right up to this is a 38.2% retracement, got a little bit above that, but then we ended up closing right below that level. Our different sectors, healthcare was down, consumer discretionary was down. You only had two sectors that were up. Well, you had more than that, but the financial sector was up over 1%, and energy, which has been getting hit pretty hard lately, it was up 3.44%. Technical analysis rating, energy, utilities, and industrials are all into the 90s, so their charts are looking good, where you still have communication below 10, and that's looking the weakest, but has been showing a little bit of improvement lately. Energy picking up a little bit of what was lost, still the best performing sector of 2022, followed by utilities, with all of the other sectors being negative. Communication is in last place, and then you have discretionary right after that, and then tech. So a lot of damage that's still out there. Here are the indexes going back to the all-time high set in early January with the S&P, where the NASDAQ and the NASDAQ 100, they were down the most. They've also been roaring back the best, even though they were down in Thursday's session. We had some technical alerts. We had the financial sector. It crossed above 70 with a BPI reading. Canada got back above 20,000. The NASDAQ got over 12.9 and then 13, and then went back below 12.8. The dollar actually went below 105, but it got slightly back above that by the time we closed everything out. That's kind of the level I've been watching, because as I've said in some other videos, if the market's going to get set to go higher, it's probably going to be at the dollar's expense. So the dollar's just been going really high, and that's provided a headwind for stocks to advance in 2022. If we are really seeing a shift with the dollar going down, sometimes that gives support to stocks. All right, let's go back and look intraday. We opened up with a gap after the PPI came out. We went above R1, above R2. R3 was way up here somewhere, so I didn't put it on the chart. We ended up topping out at about 42.50, a little higher than that, and then dropped back down. We came all the way down to R1. We never did fill the gap at that point. We drifted sideways, tried to go up a little bit higher, and then came back down. We ended up going below the unchanged level and then kind of going sideways into the close, and just closed a little bit off of the low in Friday's session. Our trend is still positive. We're above 20. We're above the moving average, and the green line is on top. The Arun also, the green line is on top. That's positive. Selling is decreasing. That's positive. So overall, our oscillator is above zero and advancing. Looking at breadth, we saw kind of a nice advance based on price and a little bit of a rollover based on volume. The advance decline ratio also showing a bit of an advance. New highs, new lows continue to advance. So see, it picked up some of our charts picked up the early positive signs that didn't really carry over into the close. And accumulation distribution, it did come down a little bit, but the moving average is still advancing, and it is above the moving average. Short term, we wore off the advance decline ratio. We were looking a little extreme positive with the decline. That's now worn off. Our moving average tree, we're now starting to deal with the 200-day moving averages. Can we stay above this? Can we get up to the simple moving average? That's what a lot of investors use. If we can get up to that, don't expect us to just blow right on through it. There's going to be a real tug of war at this line, if we even get there. And then if we do break above that and close above it, man, the financial media is going to go nuts. You're going to see headlines on the internet, because this is the deciding line between a positive and a negative market. If prices are above the 200-day moving average, that's positive, and then negative if it's below. All right, then the rate of change going back 20 periods, still looking pretty extreme positive. The Stochc RSI, extreme positive. These are our shorter term indicators. Williams percent R declined, but it's still extreme positive. The force index, it's not really extreme right now. It did decline slightly. The Swinland Trading Oscillator based on price showed an advance and volume showed an advance. The McClellan Oscillator declined a little bit, but is still kind of extreme positive. The 20 period moving average study still advancing in extreme. The 50 period still advancing in extreme and showing some improvement with the 200. Stochastics, and this is kind of what I'm talking about. We've kind of been chopping around up here, and we're not breaking down below these levels on really any time frame of the stochastic. So this is still suggesting a more overbought condition, but this can last for a while. Intermediate term, Sean trend meter, pretty much flat to slightly lower. PMO still looking positive overall, as well as based on price and volume. The PMOs that are rising, still extreme positive and declined a bit, turning back up with the buy signals. Those that are above zero continue to advance now are starting to look a little extreme. Chaikin Oscillator showed some weakness. Chaikin Money Flow showed a little bit of weakness, but is still positive. We're dropping off with volume right now. The histogram and then our measurements overall continue to decline. The vortex is still positive overall. The green's on top, the red's on bottom. The summation index based on price and volume continue to advance. And here's slope. It actually rolled over and is looking slightly negative now, but all of our other oscillators are still looking positive. The BPI actually ticked up a little bit. It picked up a little bit of the strong open and then didn't really fall back. But this is also looking a little extreme positive because it's above 70 right now. Ease of movement turned up slightly, even with a bit of a down day. Ultimate Oscillator declined just a little bit, but is still positive. Our intermediate term rainbow, we're coming up out of the upper side of the rainbow. And if this can stay this way, you're going to start to see these other moving averages turn back up, and the ribbon itself is going to do a flip flop if that can continue. The money flow index showed a little bit of an improvement. The CCI for 14 and 20 continue to be extreme positive. See, they're not working these things off. Our 9-period RSI, it declined a little bit, but it's still extreme, where the 14 period never did go extreme, at least yet. Here's the TTM squeeze. When we see a darker colored bar, that's positive with a little bit of a warning sign attached to it. Different charts. The Heikin Ashi still looking okay. Kegi still looking okay. The Renko looking okay. 3-line break okay. Actually added another X with the point and figure chart. It picked up the positive open, and we're still working off a triple top breakout. The Elder, with this decline for the S&P, has switched back to neutral, as did the SPY. The SAR is still positive with the dots underneath, and the go no-go system remains positive. Long-term charts, these are our longer-term moving averages in our little rainbow here. We're still kind of working our way up through the middle of this currently. And then our longer-term moving average study still advancing with the 50, 150, and 200. Special K is still trying to turn up, but we're seeing a declining moving average. Bond market, broad market, sorry. The diamonds are still positive. And here's the Dow coming up to R1, which is not too much lower than its 200-day moving average. The Qs switch back to neutral. And here's the NASDAQ 100. It came up to R1, got a little bit above that, and then dropped down. Here's the Vixen, which saw just a little bit of a tick up in Thursday's session. The NASDAQ also got above R1, but fell back. Mid caps came up to its 200-day moving average. That acted as resistance and fell back down, even though they ended up being positive on the day. The Wilshire came above R1, but then fell back down. The dollar was down slightly and is still in an overall uptrend, but it has been showing some recent weakness. Here's the correlation between the S&P and the dollar. They're kind of going more in opposite directions right now, and that's still what I've been watching. If the dollar's up or down, I look for the S&P to possibly move in the opposite direction. Gold, which has been staging some kind of a comeback, was down a little over 0.25%. Silver was down almost 1.5% after it tried to stage some kind of a comeback. Oil has been advancing. We're at 94.34. Here's the correlation, which is pretty much neutral. Now, when we get to minus 0.25 and plus 0.25, to me, this is neutral territory. It's when we're starting to break above. This means they're going in the same direction. When it breaks down below, that means they're going in opposite directions. Looking at bonds, we still could be building a bit of a base here and coming up out of that, even though we were down 0.56%. The world bonds were down a little bit more, but also went down and tested the COVID low and have been bouncing back up since then. And then this is a newer chart. This is the stocks. This is using the S&P 500 against the BND, the big bond ETF. And what would be nice is if we can see these going in the same direction. And they are doing that, even though this relationship is weakening a little bit. Because if bond prices can go up, interest rates will come down. That could provide some more that can provide some support for stocks to go higher. Our yield curves, we still have the 10 to the 5 negative and the 10 to the 2 negative, and we're still keeping an eye on the 10 to the 3 month. Here's the tech sector to the 10-year correlation. They're kind of almost moving together now, but not a real strong relationship. This is just a mess. This looks like smash up derby over here, where these lines are crossing each other and flipping all around and going in different directions. It just means there's a lot of confusion right now, where you had the employment report last Friday that was really strong, and then we had CPI and PPI this week, excuse me, and they're showing some different conclusions right now. And so the bond market's just kind of going a little spastic currently. Here's our scenarios. The 200 period moving average. This is still holding up. There's the red arrow. For this to continue holding up, we want to see this bounce and continue to go up, followed by, or at least leading the way, would be a higher move in the S&P 500. When we look at the 50 period moving average, also continues to hold up with the S&P, the mid caps, and the small caps. Then looking at the 10-day average of the highs and lows within the S&P was extreme negative and is still bouncing higher. Here's looking at the Amex, NASDAQ, and the NYSE after giving an extreme negative reading has now been showing some improvement. That could give some support as well. But this doesn't line up as much. See where we had the low here? This sometimes can lead the low in the markets. Here's the equity put call ratio. After working off of this spike, it has continued to decline as the equity put call ratio has declined. Small cap index, it spiked up and then closed right about at the open, but was still up 0.64%. Here's the ratio, where it's just showing that small caps did outperform. It's really hard to see, but this ticked up slightly with the small caps doing a little bit better than the S&P. This is the spike up that we want to look for on the red chart, which can give some support to the blue chart, which is the S&P 500. Here's the correlation between the S&P and the 10-year. Also, not a real strong relationship, but tending to go in the same direction lately. The Copic curve is we're still working off this signal that was generated. Well, you could go all the way back to the middle of June when we set the low, but we like to see confirmation when it actually crosses above the moving average. I use a 10-period moving average on here. If you use this indicator, you might suggest using maybe a shorter term moving average, but you can get whipsawed a little bit easier then. All right, here's our sector rotation. It did decline with the Qs, discretionary, and growth, but is still above an advancing moving average. Same thing with the large, mid, and small caps. Declined, but the moving average is still going higher. Here's the correlation between the S&P 500 and the 2-year. Fell back a little bit, but they're tending to go kind of in the same direction right now. It's really hard to tell if this is a legitimate spike right now. We haven't taken out this spike yet, but again, when we do take this out and it really starts to go down, this can mark some kind of a bottom in the S&P 500. The staple sector was down 0.25%, but we're still above both moving averages. And here's the big one that I've been watching, where we This still looks like a good solid spike where that often marks a low in the S&P. We've now been falling back, but we've been in this place before. We want to see this drop down even more. And then we want to see this follow through with the price in the S&P. All right, so what's our outlook for Friday? We're still positive overall with our technicals. We're still neutral with sentiment. We have consumer sentiment coming out on Friday, and that's kind of the biggie. And then the whole list of geopolitical events that are going on. Let's see, I added military exercises that are happening in Taiwan and in China. The ones that the markets are really fixated on are inflation and interest rates, anything that some folks from the Fed may say. And then we're still going back and forth with the recession debate. So, what are our scenarios? We can't really choose much of a down scenario right now. We're not seeing that in our charts, but any one of these reasons could cause the market to really fall if they end up having an impact. But then we want to see that follow through into our charts. Just not seeing that yet because the technicals continue to be positive. The up scenario is what we're going with right now because of the positive technicals. And there's a real disbelief that the market can go higher. And if we do start to shoot up, there's going to be the fear of missing out or FOMO. Our scenarios, even though they took a bit of a hit, they're still looking okay. The sector rotation is still looking okay. Our positive setups are still looking okay. The technicals are showing a lot of improvement. We're back above a lot of the moving averages. Now we're dealing more with the 200 period moving averages. We want to be aware of the pivots, either as resistance or as support, as well as the fib retracements. And then going back to highs and lows, they may provide either support or resistance. And then we're not sideways right now because the ADX is above 20. The green line's on top, so it is positive. So here's our conclusion. Not a real difficult one to make. We have to say the S&P is positive, short-term positive, intermediate-term positive, long-term negative, because we continue to be below the 200-day moving average. You could amend the short-term a little bit because we're still seeing some extreme positive readings with a few of our charts. So thank you. Have a wonderful Friday. I will look at preparing the video for Monday over the weekend. I also will look to prepare the weekly video and the intermarket analysis video over the weekend as well.